We begin week 5 of our business finance class. Good evening, everybody. This is Professor Hassey. A little bit late start this week because of the holiday week. Today is Wednesday, November 23rd, and this is our introductory video for week 5, capital valuation and capital budgeting. We're going to talk about investment return analysis this week and discounted cash flow. Where you go out and raise capital by borrowing money through bonds, borrowing money through bank financing, by issuing stock, issuing equity, using accumulated retained earnings as an investment vehicle, and investing in an asset. And is that asset going to pay off the proper returns to pay back that capital investment and earn a profit in addition to that? This is what we're studying in chapter 8 and 9. We also this week in our weekend update video, we'll be reviewing the midterm examination, and by then all the grades will be posted to the midterm this week. And also a highlight this week is I've scratched one thing off our calendar of things to do, the case assessment paper. That we will not be doing that in this class. I will be incorporating that analysis in our final examination. So no need to worry about a case assessment paper. All right, this all leads up to our assignment number 3, which will be posted next Monday after the Thanksgiving weekend, and which you will be doing a spreadsheet and a capital budget analysis due on December 4th. But all that, let's take a look at where we stand in our Blackboard and talk about our subject for this week, number 5. There is no graded work this week, which might be a nice change for you all, and especially because it's the Thanksgiving weekend. So there's no graded work this week. Our work is just studying up on the capital budgeting and learning how to use that in a spreadsheet analysis. So if we look at our Blackboard, if we go to the course syllabus schedule and information file folder, there you can see that I have now yellowed out the case assessment paper for our class. We will not be doing that. To make up for that 20%, I will be in assignment number 3, making assignment number 3 worth 20% of your course grade, and also adding another 10% to the final examination, making it 40% of your course grade. So that's what I'll be doing to make up for this assessment paper. And the reason why I've changed this to our schedule and to our timeline is I just feel that I'm going to be pushing you a little bit too much with assignment number 3 and the final examination work, that to add another 10-page paper to all that would be a little bit too much in this 8-week course. So that's why I blocked it out. And we'll just incorporate that into, you're going to be doing part of this case paper in assignment number 3, the actual capital budget analysis spreadsheet, and then the review and the interpretation of that will be included in the final examination work. So that's where we stand. So no grade this week. Your midterm examination, which was posted last weekend, those grades will be posted this week, and I'll review that in our weekend update video after Thanksgiving. So let's take a look at where we stand in week number 5. There's our learning assignments this week. We're going to be looking at chapters 8 and 9 and a couple of problems in a class review spreadsheet that I'll talk about this week. And in the actual file folder, you'll see our agenda, which you saw in the beginning of this video, an analysis and the key points and key pages to read in chapters 8 and 9 of our text. Some nice videos explaining capital budget, some of the PowerPoints of chapters 8, 9, and 10. And also our finance fact this week is defining what a capital budget is. I would pay a particular attention to this. This explains the process of what we're doing these next couple weeks of our class. So the first thing I'd like to do is go over some key work about defining the key points of chapters 8 and 9, and that's in this week 5 in-class review spreadsheet. So you can follow along with me after you're done with this video. This is the template you'll be using for assignment 3 and for some work in your final examination. This is the problem I'll be reviewing to talk about investment return analysis. This will be the problem taken from your textbook. It's on. It's at the end of chapter 8. It's the very first questions, problems 1 through 9, and we'll be doing this right now in our class review lecture. This is interpretation of a series of cash investments and cash flows off that investment, and what is the investment criteria? Is this return enough to warrant the investment, in this case of $200? And we use 4 key return analysis that are talked about in chapter 8: the net present value method, the internal rate of return method, the profitability index method, and the payback method. These are the 4 you'll need to know for future work in this class. So let's take a look at problems 1 and 9. It's on page 264, 265 of your textbook. And this is the problem we'll be using to explain these 4 criteria to determine whether investment is feasible or not. So let's take a look at it. First of all, we have 2 different investment decisions. We have 2 choices. One's project A and one is project B. We're going to be spending $200 on that asset. So we're going to keep this pretty simple with the numbers, but this could be hundreds of millions of dollars, but $200. And then it's expected to generate project A over its life of 4 years, $80 a year in cash flow return. So on an investment of $200, this is generating a return of $320 over 4 years. Project B is a little bit shorter. Same investment of $200 into this asset, and it's going to generate $100 a year for 3 years, and that's $300. So 320 versus 300. What is the better investment? Now you might say 320 is better, you're making more money. But also you might say that 300 is better, you're getting it faster. So that's what the analysis is that we're going to be doing, and converting this into a spreadsheet to do this analysis as described in chapter 8. The key thing to remember is, why did they pick 4 years for project A and 3 years for project B? That is considered the depreciable life of this asset investment. And you remember depreciation from our financial statements and depreciation from your study in accounting. Depreciation is the amount of life that expected this asset to last. That depreciable life is determined by Internal Revenue Service, tax tables. So the depreciable life of a project or an asset determines its cash or investment return, depreciable life. So let's take a look at the spreadsheet in that review sheet that I showed you earlier in Blackboard of how to do this problem. Okay, this is chapter 8's problems 1 through 8 in chapter 8 we just saw in the textbook. I've set this up in a spreadsheet, and all our work in this regard will be done on spreadsheets. So first of all, I've set up project A and project B. There's the $200 investment today in year 0, and the generated income or cash profits for 4 years, for 3 years. So as I indicated in the beginning of today, we have 4 methods to determine the return on these investments. One is in dollars, it's called net present value. One is in a percent, it's called the internal rate of return. One is in a ratio considered called the profitability index, and one is in years, the payback years. Same numbers, same information, 4 different ways of looking at the return on this investment, in this case of $200. Now let's take a look at this. Couple things you need to know. What is the investment? There it is right there, $200. How long is the return? Project A is 4 years, project B is 3 years. And how much cash flow is being generated off that investment? $80 a year here, $100 a year here. In chapter 9, which will be the subject of our Friday or weekend update video, that chapter 9 is, how did you get these $80? How did you get the $100? Chapter 9 is about cash flow, how to determine cash flow. How did they come up with these amounts? That's what chapter 9 is all about. And this problem in the spreadsheet right here is a problem 914 in chapter 9, which we'll review this weekend video, of how you go about determining the cash flow. This is huge. This is huge. Every CFO, every financial manager in the world does this numerous times when they have to determine what is an investment feasible to make. Another thing you need to know in this analysis, besides the investment, how many years, and the cash flow, is what is the cost of capital? What is the discount rate? What is the hurdle rate? What is the weighted average cost of capital? All three of of different names for the same thing. How much is it costing us to get this $200? Well, in this example in the textbook, it's costing us 11% to get this $200. Pretty expensive money. Probably the company's credit rating is not that good, or high inflation times like we're in now, interest rates go up. Whatever, that's what it cost us to get the money, 11%. And that's considered our discount rate. So in the net present value method, what we're going to do is we're going to take this cash flow over 4 years and over 3 years and discount it at the cost of capital, 11%, to get our discounted cash flow. Let's do that in a formula. Formulas, function, financial. We've seen this before. Net present value, NPV. There it is right there. Hit OK. It brings up the argument or the way of doing it. The interest rate is the cost of capital, 11%. And the value is the cash flow being generated over the time span. So in value, I just go back to my numbers and paint, from year 1 to year 4. So I'm taking B5 to B8, and it's including all those 4 years of $80 payments. And then if I hit OK, it tells me that that $320 in today's dollars at 11% is $248.20. So I'm making an investment of $200 today, generating future cash profits or inflows of $320. That $320 discounted at our cost of money is $248.20. Taking away the investment, the net present value amount is $48.20. We're generating a net return present value of positive $48.20. Let's do the same thing for project B. Formula, function, financial, net present value, same cost of capital, 11%. And now the values are from year 1 through year 3, the $100, C5 to C7. There's our $100 payments or inflows. Hit OK, $244.37. So that's the discounted value of this $300 discounted to today at 11%. So we're making a net present value of $44.37. So in terms of real dollars in today's value, project A is our winner. It has a little bit higher net present value. So that's the one we would pick. Now let's take a look at what this return would be in a percent. That's the internal rate of return. Let's clean this up a little bit. Get that out of there. Make it nice and official. There we go. Well, let's take a look at the internal rate of return. Again, formula, function, financial, internal rate of return, IRR. What is the return in a percent of these cash flows versus the investment? Hit OK, and all we have to do here is paint the values. But in this case, using IRR, we include the investment, year 0 through year 4. So I'm including B4 through B8. I'm including negative cash going out and then money coming in. What is that in a percent? 21.86%. So this project A is costing us 11% in money to get the $200, and it's returning 21.86% in real value. Let's take a look at project B. Same procedure, formula, function, financial, internal rate of return. And again, we paint from year 0 to year 3, C4 to C7. And what is that in a percent? 23.38%. Interesting. Why? Because it's telling us that we're getting the money quicker. So the interest rate or the return rate is higher than, even though project A is returning more money, project B has a better percentage return because you're getting the money quicker. Two different ways of looking at an analysis. More money, greater return. The two differences between project A and B. Let's take a look at the profitability index. The profitability index is a ratio, and the ratio is the relationship of the discounted cash flow to the investment. So I just put in the formula equals the discounted cash flow divided by the investment, and I get 1.24 times greater. In other words, the return is 1.24 times greater than the investment. Let's do that the same for project B, and we get 1.22. Okay, makes sense. The discounted cash flow is higher for project A than project B, thus the ratio would be a little bit greater. And then the payback. How long does it take us in real dollars to pay back the $200 in years? After the first year, we've paid back $80. After the second year, we've paid back now $160. At the end of the third year, we've now paid back $240. Okay, so by somewhere between year 2 and 3, we've paid back the $200. All right. So 1, 2, 3 years. So it's a little bit more than 2 years to pay this back, because at the end of 3 years, we've paid it back plus earned an additional $40. So how do we determine that in actual years? Well, $160 at the end of year 2 have been paid back. That leaves $40 to remaining. $40 left to be paid back to the $200. We're earning $80 in year 3, so $40 remaining as a percent of the $80 is 50%. 1, 2.5 years. 2.5 years. Project B is a little simpler. It's taking us exactly 2 years to pay it back, not 2.5 years like project A. So in terms of payback, naturally project B is the more attractive one because we're getting the money quicker in 2 years instead of 2.5 years. 4 different ways. And those 4 different ways are all showing that 2 of the ways favor project A, net present value and profitability index, and 2 of the ways favor project B, internal rate of return and payback. So that leaves quite a dilemma for the company to decide which one they're going to invest in. And a lot of that is determined by the culture of the company. What do they feel comfortable with? Do they want to make more money, or do they want to get their money quicker? Most companies would choose getting the money quicker, because once you get the money quicker, you can reinvest those returns back into other projects and other investments. But it depends on the company. For example, Ford Motor Company uses the profitability index ratio. Ford does. That's their culture. Apple Computer uses payback, how fast we pay it back. Net present value is used by General Motors. And internal rate of return is by General Electric. Every company has their own way of looking at their investments based on the culture and the history of their decision making in the company. It can depend. Some companies look at all 4 and kind of weigh them against each other. So this is a key point, and this is what chapter 8 is all about, is how to determine, excuse me, I have to sneeze. Beg your pardon. Chapter 8 is all about the 4 methods. They actually talk about 6 in the chapter, but these 4 are the only ones that you need to be familiar with that you'll use in future classes, and they're the most popular. Is what of an investment, how much is it going to return to us in dollars, percent, ratio, and payback analysis? You need to know these 4 methods. And to do these 4 methods, you got to know the investment, the length of the investment life, how much you're returning, and the cost of capital. Put all those together and you get this information, which you can now make a strategic decision. In chapter 9, in our weekend video, we'll talk about, as I said earlier, how do we get these amounts? Well, these amounts are considered what is called net cash flow. Net cash flow is equal to net income plus or minus working capital plus depreciation and plus salvage value. Remember, net income is made up of revenues minus expenses to get net income. That's an accounting term. And then we add to it or subtract to it working capital, add back in depreciation and salvage value. That's how much the asset's going to be worth at its disposal. Put all those together and we can calculate this. If any of you are looking for some things to do over the next 48 hours or so over the Thanksgiving break, you can go ahead and look at this problem in chapter 9, 914, where it gives you the parameters to determine net cash flow. And you can determine that on your own. I will be going over this in our weekend video of how to fill this in to determine our net cash flow. And then once we get the net cash flow, we can do the net present value and all this other calculations like we did right here. But you got to get this cash flow in order to do that. And that's what the problem is all about. The cost of capital in this problem is 12%. That's what we'll be doing in our weekend video. Assignment number 3 will be doing this problem. I will give you the parameters. You will put together a cash flow, and then you'll do the investment analysis. That's what assignment 3 is all about. So this is the beginning of preparing for that for next week. And we'll pick this up, this problem in our chapter 9 discussion in our weekend video. So our weekend video after the Thanksgiving holiday this coming weekend will involve reviewing the midterm examination and doing this problem in chapter 9. But take a look at this. Maybe try to download this spreadsheet and try to calculate these numbers on your own using the formulas that you talked about and see if you come up with the same numbers. Again, this file is located in our week 5 in-class review, and please take the time to go over the information and read these pages in the chapters and look at these videos and look at this detailed definition of capital budgeting. This is what we're working on over the next 2 weeks of our class. And the key thing about it is we're trying to determine what is a measurement of an asset investment's its return. We invest $200 in an asset. How can we determine what we anticipate earning off that investment? Every investment in assets in the world, in business, you buy a new plant, you invest in a new computer system, you buy a new phone system, you buy a new bunch of computers. That whole analysis is called capital investing. And the process of determining whether that investment is going to be profitable is exactly what we're doing here in this capital budget analysis, return analysis in chapters 8, 9, and then next week, 10, 11, and 12. All right, everybody, that's where we stand for this evening. Have a great Thanksgiving, and we'll see you all this coming weekend. Take a look at your Blackboard, get up to speed for this weekend's video, and you'll be in great shape. Have a great Thanksgiving and be safe, and we'll see you this weekend. Adios.